There's a quiet $100 billion wealth transfer happening right now. While retail investors are chasing meme coins trying to hit 5x, 10x, 50x, and 100x returns, institutions are slowly getting richer and richer by taking advantage of this single and simple strategy. Smart money is positioning themselves at the forefront of this industry without even having to take on any meme coin exposure. And the thing is, anybody can take advantage of this strategy, not just institutions. Retail investors like yourself, as well as myself, can do this as well. The thing is, most retail investors have no idea what this strategy actually is because they just simply don't have the right information in front of them. Now, this simple strategy is called Decentralized Finance Liquidity Provision. But before we dive into the liquidity provision aspect, let's dive into the decentralized finance part. Decentralized finance is an industry with $105 billion to date in it, with a peak of nearly $180 billion. You could see this industry slowly grow from late 2023 being at $37 billion all the way up to recent days of $105 billion. This money is growing on a day-by-day basis, and the more money that comes in, the lower the returns are for the rest of us. So the opportunity is time sensitive, and the time to take action is now. Now, what exactly is this $100 billion industry? Well, it's the same overarching industry that Pump Fund, Jupiter, Swap Radium, Orca, and many other platforms that maybe you have interacted with or even heard of in the past are in. The thing is, you've probably seen a lot of meme coins be launched. But with that being said, meme coins are not making it to centralized exchanges unless they have immense hype behind it to the point where centralized exchanges can actually make money. Because centralized exchanges are not going to list every meme coin that comes up. And at current time, there is about 1 million tokens being minted every single day, meaning that there are 1 million new cryptocurrencies being listed, and it's just not rational for centralized exchanges to be able to list all these currencies, which is where people flock to these platforms like Pump Fund, Jupiter, Radium, and Orca. But the thing is, in order to go over to these platforms and execute trades, they need Solana, they need USDC, they need other primary cryptocurrencies, ones that aren't meme coins, in their wallet, so that way they can actually trade into these high-risk meme coins to potentially make their 5 to 10x, which is really only going to happen less than 1% of the time. The odds aren't in your favor. Well, the thing is, since this industry is decentralized, that's why anybody can create a meme coin. That's why there are 1 million tokens being minted every single day. But that's also why you can take advantage of these millions of tokens that are being minted every single day without actually having to invest in them yourself. See, people want to be able to swap their tokens. Perhaps they're swapping Sol for Trump token, or maybe they're just swapping USDC for Trump token. Ultimately, they have to swap to get into Trump token. So what they're going to do is they're going to come over to a platform like Jupiter or Radium or Orca or another platform, and they are going to go and swap, say, 100 USDC or 1,000 USDC or whatever amount of USDC, Sol, or other cryptocurrency for Trump token. And you'll notice that we are putting $1,000 in right here, and we are getting $997 out. That's because a small fee is being charged to the person that is trading, which in this instance would be us, but we could be on the other end of that fee actually earning a share of that. Now, obviously, at this scale of $1,000 per day, it's only $3 per day in fees being generated. That's not a lot. But when you look at the overall decentralized exchange industry, platforms like Uniswap, which is the largest decentralized exchange, currently has $5 billion of liquidity and is generating $5.3 million in fees every 24 hours. Radium has $1.7 billion of liquidity and is generating roughly $6.5 million in fees every 24 hours. Meteora has $1.1 billion in liquidity and is generating $9.7 billion in fees every 24 hours. The list goes on and on and on. There is a complete lack of liquidity compared to the trading volume that is happening on decentralized exchanges right now. So what if you could earn a share of that fee? That's exactly what you can do through this industry. Because since anybody can launch a cryptocurrency, well, obviously it's not whitelist only or it's not invite only on who can actually put the capital up and allow those cryptocurrencies to be traded. Anybody can also do that as well, which is where liquidity providers come into play and DeFi liquidity provision enters the chat. Now, granted, we could provide liquidity for these meme coins, get way greater than 1,000% APRs, but the thing is, these are annual percentage returns. Ultimately, this is being estimated based on a couple days of data. Well, KFC token is probably not going to be here in a year's time, right? So we can't count on the fact that we are going to earn a 6,000% APR. Even if this was doing, say, 5% a day, 10% a day, we have to bet on the fact that KFC token is not going to substantially decline over time. Because remember, when you're providing liquidity, you're taking on exposure to cryptocurrency assets. So if we provide liquidity for Sol and USDC. We are underwriting these trades, allowing people to execute trades of Sol and USDC going back and forth, but we have exposure to both Sol and USDC. Sol goes up, well, we are losing some exposure to Sol because people are buying it. Sol goes down, we're actually gaining exposure to it because people are selling it, therefore meaning our USDC is being used to buy Sol in a sense. But the thing is, people are going to have to trade Sol and USDC, people are going to end up trading Sol and Ray token, and people are going to end up flipping their profits into other ecosystem tokens wherever there are meme coins. At least smart investors and institutional investors will. There is a lot of infrastructure products out there that power different aspects of the Solana network, of the Ethereum network, and you can invest into those projects, take advantage of the revenue that's being generated from those projects, which is ultimately being generated because there's a lot of people trading meme coins on those networks. That's exactly what you can do through decentralized finance. And the thing is, this is an industry that goes far greater than meme coins. If we use the logic that people have to trade USDC for Trump, or trade Sol for Trump, or trade whatever cryptocurrency to get whatever other cryptocurrency on the other end, and we just accept the fact that people are going to be trading cryptocurrency assets, which if you're already investing into crypto, you already know that that is happening on a global scale, then we can accept the fact that it would make sense to provide liquidity for not meme coins, but rather high utility assets, blue chip assets that are going to be traded in order for people to go and trade those meme coins. And if we accept that fact, we can then dive into liquidity pools for these assets and get very, very good returns, like 65% on sold to USDC, 95% over on sold to USDT, 100% on sold to Radium, 215% on sold to Trump, and so on and so forth. The returns get better depending on what risk level you're comfortable with. But again, retail is too busy creating all these meme coins, trading all of these meme coins, and literally blowing their money and having worse odds than if they were to go to a Vegas casino, to the point where they haven't even realized the people that are taking advantage of them. So with that being said, it prompts the question, do you want to be taken advantage of as a retail trader, or do you want to provide liquidity and take advantage of the trading fees and the trading volume that is happening and essentially accumulate more assets? And what I mean by that is, say right now you have one Sol. Wouldn't you like to have 1.1 Sol, 1.2 Sol, 1.3 Sol, and let your Sol stash grow, even if the market is growing, say 200 Sol to 250 Sol to 300 Sol as well? You have double the growth as opposed to having one source of growth, and that is speculating on future prices of assets. Now, while these opportunities are here to stay, and while these liquidity pools will be here for years to come, and people will continue to trade these liquidity pools because DeFi is the future, it takes the power out of the hands of the bank and puts it in the hands of retail investors and people like you and me, where we have equal rights. These yields are time sensitive. Right now, I'm currently getting 96% APR on CBBTC to Sol, which is a derivative of Bitcoin paired with Sol. So by taking on exposure to Bitcoin and Sol, not only am I going to see all the asset appreciation when Bitcoin and Sol both go up, I'm also going to see a 96% return every single year on my actual underlying assets, which means right now I have 42 Sol roughly and 0.035 CBBTC roughly. That is going to continue to grow day by day as I accumulate more assets. If we look at my pending yield, which is just $16 right now since I entered this pool a couple hours ago, you could see that I've already accumulated an extra 0.046 Sol and about $7.50 of Bitcoin so far. So not only do I have what I started with, I have accumulated more assets and I've seen all the price appreciation that's happened. Now here's the thing, what you would normally get in traditional finance in a year is happening in a month in DeFi. This industry is going to continue to grow in these lower risk pools that are doing super high returns right now. Those returns are going to go down. And ultimately, while there are still going to be high yield opportunities in the market, it is going to be harder and harder and harder to find those high yield opportunities, but you're also going to have to take more and more risk over time to get the same returns that you could get right now. And this right here, these liquidity pools are the smart money advantage. This is exactly what smart investors are positioning themselves in, so that way they can maximize their profits this bull run and ultimately create a flywheel of growth so their portfolio continues to grow market over market and year over year. Now, we have a strategic framework that we use to build positions like this: Ethereum to Desync doing a 95% APR, Ethereum to Ondo doing a 185% APR, where we can consistently produce cash flow on our assets. The thing is, these are not random meme coins. Desync is a project that is generating roughly $500,000 per month in profit at current date. Ondo is a real-world asset protocol that allows you to invest directly into treasury yields on the blockchain. So there are use cases for this industry far beyond just investing into meme coins, or I should say gambling on meme coins like most investors do. And if you want to take advantage of those opportunities, I highly recommend you stay tuned for my next video, because I'm going to be sharing my strategic framework to hunting out these positions and actually getting invested into them. So make sure to drop a like, make sure to subscribe, notifications turned on, and let me know what video you guys want to see on the channel next. I'll see you guys in the next one, and peace out.